Stop what you're doing for just a moment. Close the extra tabs. Put down the coffee. Turn off the noise. Because what you're about to hear is not theory, it's not speculation, it's official exchange policy, and it just went live. If you don't understand what this means, you may wake up one morning and realize the price you thought was real never actually existed. Before we go any further, one thing needs to be absolutely clear. No paid signals, no courses, no mentorship programs, no investment schemes. Anyone claiming otherwise is a scam. This is financial education, not financial advice. You're responsible for your own capital. Verify everything. Question everything. There is no easy money in this market. Now let's talk about what just happened. The Shanghai Futures Exchange announced an official policy change. Starting the last day of February, participants without approved hedging quotas will receive zero delivery allocation on silver contracts. Not reduced delivery, not delayed delivery. Zero. This isn't a rumor. It's published exchange policy. Think about that. A futures exchange exists for one core reason: to allow buyers and sellers to exchange contracts with the option of physical delivery. That delivery mechanism is what keeps paper prices tied to real metal, and Shanghai just severed that connection. Unless you're a qualified hedger with special approval, you no longer have the right to demand silver. They didn't hide it. They admitted it publicly. The metal isn't there. Let's look at prices. Western spot silver, about $85.90 per ounce. Western futures, around $85.40. Now Shanghai, spot silver, significantly higher. Futures, even higher still. That's a roughly 3.77 premium for the same element. Same silver, same atomic structure, but China's paying more. Why? Because in the East, you're buying physical. In the West, you're buying promises. Promises don't power solar panels. Promises don't run EVs. Promises don't build AI data centers. Physical metal does. And Eastern buyers are securing physical, while Western investors stare at screens showing synthetic prices. That premium is the market screaming, physical is separating from paper. Silver surged another 7-8% in less than half a day. Nearly $300 billion in market value added almost instantly. That is not normal price discovery, that's panic buying. Silver also rebounded roughly 35% in just 5 days. 5 days. That kind of move doesn't happen in stable commodity markets. That happens when supply breaks. At the same time, the Shanghai Futures Exchange suspended 3 more groups of trading accounts in a single day. Total suspensions in 1 week, 20 on a major global exchange. That's not routine enforcement, that's crisis management. Over 860,000 ounces of silver left registered Western vaults in 1 day. Open interest still represents roughly 340 million ounces of paper claims. Actual registered silver, around 101 million ounces. That's about 3.4 paper claims for every physical ounce. Run the numbers yourself. Ask what happens if even a small percentage of contract holders demand metal instead of cash. Short covering has already begun. That's not stability. That's traders realizing they're on the wrong side of a structural shift. Even major financial outlets are now quietly acknowledging supply constraints in silver. Retail buyers across Asia are snapping up bars and coins. Trading volumes are soaring. And buried deep inside these articles is the key phrase, silver supply constraints. They don't put it in headlines. They hide it mid-paragraph. But it's there. Independent analysts are reporting the same thing. Silver is flowing east. Vaults are draining globally. Lease rates are exploding. Mining supply cannot keep up with industrial consumption. Solar, EVs, 5G, defense, AI infrastructure. All require silver. And we've been underproducing for decades. Higher prices aren't optional. They're mathematically required. Here's the uncomfortable truth. You can print infinite paper contracts, you can create unlimited derivatives, but you cannot print metal. Paper markets only work as long as buyers accept cash settlement instead of delivery. Shanghai just told the world, delivery is no longer guaranteed. That's the fracture point. This is how physical separates from paper, not with fireworks. With policy updates, some institutions are warning about bubbles, others are raising gold targets above $6,000. Same week, same markets. Completely opposite conclusions. That tells you one thing, nobody's in control anymore. Meanwhile, gold has outperformed the S&P 500 for over 2 decades. Silver, with far tighter supply, is now showing even more violent moves. Maybe metals aren't the bubble. Maybe paper assets priced in weakening currency are. Now, let's be honest. Corrections can happen. Paper markets can suppress price for longer than most traders can survive. Manipulation has been proven in court. This could take time. There are scenarios where volatility fades temporarily, where contracts roll forward, where pressure eases. But every bearish case depends on one assumption, that paper markets retain control. Shanghai just challenged that assumption. Here's what matters. Delivery restrictions are live. Vaults are draining. Paper claims exceed metal by multiples. Eastern premiums persist. Industrial demand is exploding. Supply is structurally broken. This isn't hype. This is math. When physical is demanded, paper fails. That's the setup. Watch the delivery data. Watch the Shanghai premium. Watch vault inventories. Ignore opinions. Follow primary sources. The warning signs are public. The question is simple. Will you verify or dismiss? If this breakdown helped you understand what's happening beneath the surface, leave a comment. Let it be known you're paying attention. And remember, invest with logic, not hype.